Hello and welcome to this week's US stock market report. Whilst the weather on the East Coast is wet, windy and wild and a little bit cold, the stock market is hot right now. In this report I'll give you my thoughts on the Dow Jones and the S&P 500, where the US stock markets are heading, along with answering your questions and looking at stocks that you've chosen for me to review for you. Hello, I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now before we move on, thank you for showing your support for our channel and hitting that subscribe button. Now remember, as you subscribe, click the bell on the right of it so you keep up to date with our latest videos. Everything in the market at the moment is about earnings, and they're expected to rise into 2020. Now remember, last year earnings were up one quarter, down the next quarter, up the next quarter. It was all about 0.3% that earnings were playing that seesaw type of game. But since the start of November, the S&P 500 has risen just over 9%. On expectations that earnings will improve in 2020. Now, what I say often is that the amateurs buy at the top and the professionals buy at the bottom, but the professionals are buying at this point in time, pushing those markets to highs, and now what we'll see is the uneducated starting to get into the market now based on these 9% rise over the last couple of months, but earnings are expected to rise. Now, whilst in the fourth quarter 2019 earnings are expected to be slightly lower than the third quarter, we haven't seen the fourth quarter report yet, but they are expected to be slightly lower, probably about a 0.3 again, because as I said, they've been up and down 0.3% a lot in 2019, but we did see that seesawing each quarter. However, the analysts are expecting 2020, they're expecting a significant increase in earnings, somewhere around about the 6% growth in earnings. Now that may have something to do with the China trade effect, which I'll talk about in a second, but I'll let you know before you get too excited, the market has moved very well already on this expectations. And so this strong bullishness may start to slow soon. And it's a lot of people wait for things to happen before they get in. And, as we know, the market, if you're not in the market at the moment, that 9% rise you haven't got. So don't expect it's going to do the same in the next couple of weeks or the next month. It may not do that. That's really what I'm saying, is the amateurs tend to buy after the run's already happened. But I want to ask, is the S&P 500 getting too top heavy now? Because the top 5 stocks in the S&P 500 now make up just under 20% of the whole index. Now there's 500 stocks in the S&P 500 and 5 make up 20% of that in that market capitalization, or the whole market capitalization of that whole market, so just 20 stocks. Now Alphabet is one of those stocks. It was up 45%, Apple up 102%, Facebook up 69%, Amazon up 24%, and Microsoft up 64% since 1 January 2019. So we're talking about 1 year in a couple of weeks, and those are the returns of those top 5 stocks. So we know why the S&P 500 rose so strongly last year, when you're getting Apple going over 100% and Alphabet up over 45%. We're talking about Facebook up over 69%. Amazon, the worst performer out of that, only 24%. So expect Amazon might play a bit of catch up on that. But Microsoft, again, up 64%, all since 1 January 2019. But here's another little statistic for you. The top 10 stocks are closer to 25% of the index. So what does that mean for you as an investor or a trader? The thing is the market is the reflection of the stocks within that. And when you get top heavy, what happens is the market will move with those top stocks, because if those top stocks are moving, then the market will move in that direction with it. But the top 10 stocks are closer to 25% of the value of the whole index. So looking at that, we're saying that's where I think you should be looking for a lot of times. And I talk about that in my book, Accelerate Your Wealth, is, you do look at those top 20, top 50 stocks, because they're the ones that are making the market move. When you're getting into the smaller cap stocks, and I know in a lot of uneducated investors and a lot of uneducated traders will try and find value in very small companies and trying to make money very, very quickly. But these are the stocks you're going to make the best amount of money if you buy them at the right time. And there are rules and strategies in my book, Accelerate Your Wealth, that will teach you exactly how to capture some of this sort of profit, or all of this sort of profit. Some of those stocks that I mentioned, or quite a few of those stocks that I mentioned, I actually analyse in the US version of my book, which is available in bookstores around the US and on Amazon. You can go straight to Amazon, type in Accelerate Your Wealth and order my US book. It's got green writing on there, or green colouring on the front cover, and I've used the top 20 stocks, the Dow stocks, not the top 20 stocks, the Dow stocks in that, and Microsoft's part of that, Apple's part of that, Google, Amazon's is part of that as well. So you can see how I've analysed those stocks and the rules that I've used on those stocks to make very, very good returns over a 10-year period. Actually, fantastic returns, and we're average well over 20% per annum on the rules in the book on those stocks. So that's what I'm saying, is you can make good money out of those stocks if you know how. I just want to bring up the US-China trade deal, because the phase one, or signing, or Trump signed the deal for phase one last week. I think it was Wednesday last week he did that, which is fantastic that now the phase one deal has gone, been put to bed, so to speak. They've signed all that, which shows that there is a lot of intention from the US and from China to get something happening now. And I know Trump knows it's really important, especially in an election year. He's going up for election. He's being impeached right now, which is you'll probably end up being enough type of event with being impeached. I don't see him being removed as president, considering that the Republicans, they control the Senate there. So, but the US-China trade deal is something that's critical for both China and the US. But I know there are analysts out there suggesting that some of the goals of this phase one are really insurmountable, or too hard to get, because one of the goals is that China will import $200 billion of additional manufactured goods. Now, some of the analysts are out there saying, how's China going to do that? They're not doing anywhere near that at the moment. They've got to add all of that on top of it. So China's not going to do that in the next 12 months or so. But that's negative. It's, even if it does 100 billion, it's still better for the US, isn't it? And it's still going to support manufacturing. It's still going to affect a whole lot of areas around the US, and services supporting manufacturing. And some of the goods that China are getting are things like farming equipment, those sorts of stuff. And that will help the US grow right across the board. And I think that's where that 6% earnings growth is going to come, or that proposed 6% earnings growth. But I think we shouldn't focus on whether it's possible or not. Rather, we should just focus on the fact that China is increasing its imports from the US, and this will create jobs. And I think earnings really will grow on the back of this. Now, as an individual investor, we do not need to be too concerned one way or the other. Just focus on the stocks we own and what we're looking to buy. You don't make it complex. And I find a lot of people go to me, hey, there's 500 stocks on the market, and they've got all these, does this software have scanning things and and I want to look at all the 500 stocks. No, I would suggest most people don't need to look outside the top 100 stocks, and that is the top 100 stocks on the S&P 500. If you just looked at those, you'll make absolutely shed loads of money out of just those stocks, and you forget about looking at the other 400 completely. You'll make money. But even the top 50, if you just looked at the top 50, narrow your focus down, get good at looking at stocks, those 50 stocks, have some good rules around them, and you'll absolutely beat any ETF on the marketplace. And exchange traded funds are an interesting topic for me. I don't suggest people use index ETFs, but looking at the S&P 500 top 100 stocks, the best performers for the month so far include Tesla, which is up 22%. I know Jim Beach, who normally interviews me, he was thinking Tesla was going down, but Tesla's up 22% this month, and it's over 100, I think it's 150%. I think it did in the last 6 to 9 months, or into last year. So it is up very, very strongly at the moment. I don't suggest Tesla's going to keep up that pace. I think it's going to slow down quite soon. But Morgan Stanley was up 12.5% so far for the month. Salesforce have been up over 12% with for the month, with Google also up 12%, or should I say Alphabet, the stock, because there's two parts of Alphabet, but that's up 10% for the month so far. Now, in the S&P 500 top 100 stocks, the worst performers for January so far, Wells Fargo, they're down around 8.5%. US Bancorp, they're down 6%. Schlumberger as well is down 6%. Dow, DuPont and Chevron are all down over 4%. So there's some interesting news, or some of those stocks could be like Chevron and Schlumberger. They've been hit, especially Schlumberger's been hit fairly hard last year, but it's starting to show signs that it is going more bullish. So it could be the little dark horse for the year. So that might be a good idea if you don't have a look at that. But what do I expect in the stock market moving forward? Well, let's get into the charts for our stock market update for this week. We'll also answer your questions and look at the stocks that you've chosen for me.
Please remember that this report is an educational tool. While Wealth Within holds an Australian Financial Services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Again, we saw a fantastic week on the US markets last week with both the Dow and the S&P trading out quite strongly, and it's quite interesting. When the market's really bullish, you still get the naysayers out there. Some people saying, hey, it's overheated, it's too bullish, and other people are saying, well, the market's over leveraged, or there's too much debt going around, or earnings aren't going to support things, a whole range of different issues, and there's always a negative connotation to what's going on in the market. And I think, I'm not sure what people are, what they're smoking, so to speak. The market is bullish. It has been bullish. It is going to be bullish for a little bit longer as well, and has been bullish for quite a few years. Yeah, it'll eventually run out, and yes, the market will eventually peak, and yes, it will eventually fall away, and one day again it will crash again, and that's nothing certain, more certain in my mind that those things will happen. But in the end, there's an old saying that make hay while the sun shines, and right now the sun really is shining on the US market, and I think 2020 is going to be a reasonably good year for the market. Probably not as good as last year, but let's go and have a look at the charts and see what's actually on the chart and look at that. And the reason why I like looking at the charts rather than all this fundamental data, and I see a lot of analysts have lots of different biases, and constantly I'm really in a contrarian view to a lot of analysts. Now I'll talk about that in a second, but first looking at the chart here. Now this is a monthly chart of the Dow Jones, and you can see here this is January, and so far there's a range of 954 points on the Dow, and it's really broken out of this sideways movement, and that's the really exciting part, because that was started in January 2018, 2 years ago. So the market really didn't do anything for 2 years. I think it was like maybe 1 or 2% it grew in 2 years. So it was being held back a little bit after such a spectacular rise right through from March 2007. Yeah, it is a long bull market, but we had a huge long bull market up into this 2007 high. Bull markets are getting longer nowadays, and that's something we're probably going to have to get used to. Maybe we won't have to get used to it, but right now, you always got to be, as a trader, you've got to always assume that if the market has been bullish, that it will continue to be bullish until it's not anymore, and trade on that and make your investment decisions based on that, because the market will tell you when it's going to peak out, and it'll tell you when it's going to bottom and start to rise again. So when I'm talking about the contrarian view, and I do have a lot of news feeds coming in and a lot of analysts saying, hey, the market's terrible. The Fed's doing a lot of, secret quantitative easing, so to speak, or what the Fed's doing right now is artificially propping up the market. They may well be doing that, but regardless, it's still bullish. And to me, the question is what is your plan? And my mum taught me many years ago when I was a very young boy. She said, Dale, it doesn't matter what happens. The important thing is how you handle it. So it doesn't matter whether the market goes up or down. It doesn't really matter to me. All it means is I need to have a plan for either situation. If it's going up, what's my plan? If it's going down, what's my plan? And I've never had anybody ring me up complaining about a share they own going up. They only complain when they're going down, or they panic when they're going down. So that tells me that if all you did was protect your downside by using stop losses that I talk about in my book, then you've got nothing to worry about. If the market starts to fall, you exit your stocks, put your money in the bank, put it into cash, and then wait for the market to stop falling and then get back into it. If you're one of these people that likes to stick your head in the sand and buy and hold forever and a day, then you need to be a little bit more concerned, because you'll take the dips, and whatever those dips are, whether they're small or large, you will have those. So where's the market heading right now? Going back onto the chart of the Dow Jones, and you can see here how I think it's still got some more movement up into that sort of 33,000 sort of point area. I think that will pull it up for this year most definitely. I think it's very strong probability it'll pull up around that level. I think it's going to be bullish. It won't be as bullish as what it was the last few years, even though a couple of years it did go sideways. What I mean by that is I don't think it'll be as bullish as 2019, where we saw, I think it was the S&P was up 25 or 26%, the Dow about 22%. We can have a quick look at the S&P as well, but I think we're going to see a few more months up. I think we're going to see a peak, a shorter term peak, probably sometime into February, coming down and then moving back up again for a little bit more longer period of time. But let's look at the S&P. Where is it? The SPX, there it is. So there's your S&P 500. Looks a lot more bullish than the Dow, doesn't it? And that's what people are talking about here. And most of this is your technology stocks, as I talked about in the earlier part of this report. You've got 5 stocks making up around about 20% of the marketplace, and the top 10 stocks in S&P 500 making up about 25+%. So when they're moving, they're taking that market with them, and technology, or the S&P 500 is a little bit more technology heavy, if that makes sense. And so when they're moving, they're taking the market with them. So what you need to look at is, well, what's moving along with the market, but maybe not traveling as fast as some of those stocks. But let's get into your questions for this week. Now, the first question we have today is from Christopher, who says, "Hi Dale and Janine, Happy New Year to you both. Thanks, matey, and welcome to the new decade." My pleasure, matey. Hopefully you've set your goals for this decade. It sounds like you've probably been listening to my podcasts, matey, which are on iTunes or SoundCloud and all those sorts of things. But if you haven't found my podcast, Talking Wealth is the podcast. So just Google it on your iTunes and get into Talking Wealth. You'll be able to hear my podcast. There's a whole lot of things we're working on in the US to do more videos over there, some more shows that we're working on as well, so specifically for the US market. So, but he goes on to say, "I've chosen 4 stocks to put into my portfolio: Amazon, Apple, Microsoft, and CSL. For those of you in America, CSL, or Commonwealth Serum Laboratory, is sort of like a Cochlear. I know you all the people in the US understand Cochlear implants, etc. An Australian company, a very, very good company in Australia. CSL is very similar to that. It does anti-serums and all that sort of vaccines and serums and everything else, and travels just as well as Cochlear. But looking at what your list here is: Amazon, Apple, Microsoft, and CSL. What you're picking is stocks that have been going up very, very strongly the last 12 months or 2 years or even a bit longer. So, and to me, that's not the way to be a smart investor necessarily, because some of those stocks, especially Apple, and we'll have a quick look at that, that's risen over 100% in probably 18 months, roughly about that, and they've done very, very well, but it doesn't mean they're going to continue to rise, and that's a big mistake that investors do make. They watch the market move up and they wait for the market to move. For example, as I said a little bit earlier, the S&P 500 was up over 25%. That's why I still think it's going to go, because earnings are going to rise, I believe, into 2020 and get better. The news is going to get better, but all the mums and dads and all the different people who were scared of the stock market haven't got into it yet because they've been scared of it. They're going to start getting in because they're seeing the 25% growth last year. They're seeing Apple going up very, very strongly. I think in the calendar year last year, it was over 90% it grew, or around about 90% it grew. They're saying, wow, Apple's moved up. I want 90% in my portfolio. So they go and buy Apple shares. Just because Apple made 90% last year does not mean that it's going to make 90% this year, and I don't think it will. And that's the point, is you need to look at, some stocks will lead the market, some will follow it. So you need to look at stocks that provide better value for you, that may not necessarily be at the end of the run. Because there's an old saying in the market is, the amateurs buy at the top, the professionals like me buy at the bottom. And that's really what I would have been buying Apple way back, a year or two ago, and buying it at those bottoms and seeing it rise. But I don't think it's going to keep up that pace. But we're going to have a look at the charts on it in a second. But he says, "I'm interested in each of the stocks for your thoughts as to one stock you think would be worthy inclusion to this list." I'm not going to tell you what to buy and sell, matey. I'm just going to have a look at the stocks. So let's have a look at a few of these stocks. And these are all part of the FANG stocks throughout the US. And as I said, these top 5 stocks on the US market make up a big chunk of the market. But here's, we've got Amazon here up on the screen right now, and on the left you're seeing a monthly chart, on the right a weekly chart. Now out of these, Amazon was probably the least, had the least growth out of all of these stocks over the last 12 months, and it has consolidated, but you can see the massive run that it had. And this is what I was talking about here. If you go down to here and you can say, okay, well, Look, February 2016 through to this high here in September 2018, 332%. People were buying in here because it had made 100 and 200% in the previous 12 months. So if we go to this low here, you can see 2017 September 2017, 120%. So in a year, it made 120%, but you're getting people coming into this market right through here because they thought they would continually get always this spectacular run. But then it's done nothing since then. If you'd bought anywhere around those highs, at one stage, let me click on the thing here, at one stage you would have been down 35% on that stock, as you can see there. Currently you're still down around 9.53%, but if you'd bought in somewhere around about here thinking it was going to be going ballistic for you and you're going to make 100-200% over the next 1 or 2 years. So let's go to February 2018. If you'd gone from that point there to right now, you've only made 30% over that period of time. And that's what I'm saying is don't expect big runs to continue to happen and constantly happen. And I find that's where people that are uneducated on the market, they actually think, oh, the market went 25% last year, I'm going to get it. The statistical probability of the market, the S&P 500 doing 25% in 2020 is very, very low. It's highly unlikely. Only 2 times in the last nearly 70 years it's had 20+% growth on consecutive years. Only twice. So therefore it's unlikely it's going to do that, which means the return's going to be less than 20%. So therefore stocks that are moving at all, and those big stocks that we're talking about right here, those ones won't do the big gains that they had last year, or they're unlikely to. I'm not saying it's not possible, it's just unlikely. Let's go and have a look at the next stock here. We've got Apple. We're going to have a bit of a look at that. And as I said, this is the one that really, really did take off. So if we look down here at January 2019 to currently 125%. So it did about 90% up till the end of December. So this is going vertical at the moment. It's not going to keep those speeds because investors go, wow, this one a couple of months ago was $200. Now it's $300. I don't want to buy this stock anymore. It's too expensive. And that's how we work as our psychology is. The fund managers and the big players are in this stock. They were already in it. And what's happening now is we're seeing a lot more the mums and dads or the amateur type investors trying to jump in to try and get this return. I think it'll slow down and it'll start to come back down again. But I had people through this period here saying, well, what's happening? What's happening with Apple? Because it's fallen away. It's gone. Apple's dead. The iPhone's not selling anymore as much, Android and all the others, Google coming in with phones, Apple's not going to be any good. And I said, don't be stupid. It really is. It's a really great company that makes great products. And it's good at marketing them, and that it fell 40% and people were panicking about Apple, and I said now's the time to start looking at it, and you would have made those sorts of results. So right now I wouldn't be getting into Apple at all in terms of my investing, but if I owned it I'd still be hanging with that. Let's look at Google now, because it's another one that's gone quite vertical, as you can see, very, very strong rising, and another one of the FANG stocks. This is Google. It's risen very, very strongly, and again, these are not the stocks that I'd be choosing to get into right now. I'd be looking at ones that have been holding back. So you can see there it's risen 52% since January 2019. So it's quite a strong move on a stock like this. So now's not the time to be getting into Google either. It's one, if you do own it, stay with it at this point in time. And the other one that really took off like a rocket, and one of those top 5. So when we're talking about Apple, we're talking about Microsoft, we're talking about Facebook, we're talking about Google. They're all taken off like a rocket, and in 2019, you can see here from December 2018 to now, basically the last 12 months, 80.97%. It's flying, so it's doing very, very well. I'm not suggesting it too is not going to continue to be bullish, but it won't be as bullish in 2020. But now's not the time to get into Facebook either. But let's go and look at the next question. As I said, it's going to be on Microsoft. And we got the question from John. He says, could you please have a look at Microsoft? Currently, I don't own any, but I think it trends well over time and I like its fundamentals. He says, i.e., it's into virtual reality and open source programming. I think it will capture a good percentage of the market into the future. So I'd like to buy and hold with the trailing stop loss of 10%. Have read your book and love the show, but want to know if you think I'm mad, or are there better opportunities elsewhere? Really what Microsoft, there's a lot of competition in virtual reality, and Microsoft's going to capture some of it, but that's not a reason to buy. Again, the charts don't lie, and they tell you what's happening with the stock, but 10% stop loss, I'm not sure why you're putting a 10% stop loss in, but if you've read my book, I don't even really understand why you're saying buy and hold. I don't buy and hold. I don't ever buy and hold, and I don't suggest anybody buy and hold, and Microsoft or Apple or any of those companies, I wouldn't buy and hold forever. You need to have putting a 10% trailing stop loss on a stock like that. It will dip 10 or 15 and 20%, and you'll get taken out only for it to see it start to rise again, and you're out of it, and you're going to miss some of that rise up because you're out of the stock. And some people will argue me, well, I'll just get back in again, but where are you going to get back in again? Because until it moves past the previous high, most people wouldn't touch it. They wouldn't get back into it. But let's look at Microsoft here. And again, another stock that's done absolutely phenomenal. As you can see, it's getting steeper and steeper and steeper. So again, Microsoft, I think, rose around about 50% last year, somewhere in that sort of vicinity. But you're looking at, in this last 12 months, since 1 January or December last year, 2018, it's risen 78%. So you're getting in at the end of the run, and that's really where the longer the stock starts to rise, the longer the stock rises in time and price. So the longer it takes, the longer period of time that it's rising, and the more it rises in price, the more the probability builds that will finish its run. So you want to start getting in, and Buffett says it perfectly. Buy in doom, sell in boom. Microsoft booming, Apple's booming, Facebook's booming, Google's booming. They're not the times you need to buy. You need to look at the stocks that haven't been booming and that are starting to turn or have turned already and are coming off major lows. And there's tons of those in the S&P 500 that you could be looking at. And again, there's another thing we've heard me talk about with the markets is with the Australian market and the US market is all markets are interlinked in some way around the world. Now, each one will spend their time in the sun. The US market has been the strong market over the last decade. Or at least the last 5 years. Now it's turning. The US market won't be as bullish as some of the other markets around the world, like some of the Asian markets and other markets around the world. So what I know is investors chase the returns that have gone. Like they've gone. What the returns that happened last year on Google, Facebook, Amazon, all of those, Microsoft, they're gone. They're not yours if you're not in those stocks, and they're not yours unless you sell the stock and put the money in the bank. You haven't captured those. So just be careful about following returns. Look for value elsewhere and look for value in stocks that have fallen a bit, and read my book, Accelerate Your Wealth. You can get it on Amazon and purchase it, and it'll get sent out to you. There's an ebook on there as well from Amazon, and you can download it onto your iPad or your Kindle or whatever you do as well. But thanks for sending in your questions, and I really do appreciate you sending in your question, and thanks for watching till the end of this video. Sometimes I ramble on a little bit, but I'm so passionate about helping people invest and trade. And last week I was chatting with a couple of guys, one in Texas, one in New York, and we're putting some shows together at the moment, investor shows, and they just said they love how I'm just so upfront and honest with people. I don't fluff it, and they want me to be unfiltered. I know in the US they were saying to me, it's so filtered what you hear in the US about the market, about all sorts of different things, and so they're going to let me loose, basically, if that's what the term is. But right now, if you do have any questions and you'd like me to answer those, just stick them below in our chat, and I will get to them and I will answer them for you. So get your fingers on the keyboard and type them. Remember, I do these reports every week, so hit the subscribe button now and click the little bell on the right of it, guys, so that you know when we go live with our latest stock market reports. But for now, goodbye, good luck, and good trading.